Alright, so in this video, I want to show how to sell a naked put with Questrade, and more specifically using Chewy earnings. So Chewy has earnings coming out today after market close. So usually there's high implied volatility before earnings is released, and then right after earnings, the implied volatility drops. Therefore, whatever you sold before, you can usually buy back for much cheaper in terms of options. If we look at the stock of Chewy, if we look at the past year, I mean, it has gone up a lot. It has gone from almost, I think it was trading in the 20s at some point, yeah, 22, to right now trading at $52. That's ridiculous. So 52-week low was 20. So if I were to sell a naked put on this stock right here, first of all, I'd go to option and then look up the stock Chewy, and I would look for expected move for this week's expiration of June 12. And to get the expected move, I look at the value of the straddle. So if I look at the value of the straddle, I could see that at the 52 strike expiring this week, it is trading around $7. So the value of the straddle for June 12 expiration at around 52 strike is about $7. So the expected move is about $7. So what I would do is I would sell a naked put at the strike that is $7 lower than the current market price. So 52 minus 7 is 45. So if I want to sell a naked put, I simply click on single leg options, calls and puts, and I make sure that I'm under the June 12 expiration, which is the closest expiration. And basically just click anywhere on the put side. So here I've got the call side, here I've got the put side. So I'll just click anywhere here. The order entry window updates automatically. I've got a put, and then I'll choose the strike that I want. So I wanted the 45 strike because it's 7 points lower than the current market price, which is 7 points being the expected move that we calculated based on the value of the straddle. And you can see that the bid is 70 and the ask is 75. So if I want to sell a naked put, I simply click on any price I want here. Obviously, if I want it to get filled right away, then I should click on the bid, because that's what someone is willing to purchase. And since I'm selling, so I have to look at what someone is willing to buy it for. So if I want it to get filled right away, I click on 70, and then I click on sell over here. So if I wanted to buy a put, I'd click on buy, but I'm trying to sell it. So there's different risks associated with selling a naked put, opening the trade by selling a naked put. So if I click on sell, it gives me first a small warning, confirm short order. You're creating a new short position that may have additional risks. So if you know what you're doing, click yes. So now here it shows me what I'm collecting, and it shows me my change in maintenance excess. So that's basically my capital required for this trade is 1086. Because I'm using margin, my maintenance excess is only 1086, but my change in buying power is 3616. Now I'm not exactly sure how Questrade calculates this. It's written on their website, but it's kind of confusing. But what you need to know, what's more important, is you need to have the availability to buy 100 shares of that stock at the strike price that you sold. So what you really need to know is, if I'm selling the naked put at 45, do I have enough capital in my account to buy 100 shares of Chewy at 45? So do I have 4,500 US in my account? That's what you need to look at. If you have enough buying power for 4,500 US, then that's the maximum capital requirement you need for this trade. Because if the stock, so how does this work? So by selling a naked put, I receive a premium of, in this case, 70 cents, or times 100, $70. I keep this premium if by June 12, Chewy stays above $45. Now, what happens is after earnings, there's a volatility crash. So implied volatility drops. So maybe I can close this option. I can buy it back for much cheaper than what I sold it for. So if I sold it for 70 cents, maybe tomorrow I can buy it back for 30 cents, depending on what the stock does. Maybe even 5 cents. Really depends. If the stock moves up plus a volatility crash, then I can buy it for very cheap. If the stock stays put, then I'm only getting a volatility crash. If the stock drops, then I might have to hold on to it a little bit longer. And as we get closer to expiration, then it'll expire worthless, or I can close it for cheap. But if the stock opens tomorrow below 45, so you still have a few days to go. You have until expiration, until June 12th. But what that means is if the stock is trading below 45 at expiration, you have to be able to buy the shares at 45. That's if you do nothing. So if the option is in the money, and in this case, if the stock is trading below 45, then your option is in the money, then you'll be assigned automatically 100 shares of that stock at a 45 strike. So you'll have to pay 4,500 US to buy the stock. But remember, you already collected 70 cents in premium. So it's like you paid only $44.30. But there is a way to manage it so that you don't end up buying the stock. So if you don't want to buy the stock, you can roll the option forward. So let me show you an example of rolling. So if Chewy opens below my option strike tomorrow, a way to manage this trade is rolling it. So let me give you an example as if I already sold the naked put. So if I sold the naked put, for example, here's what it would look like. If the naked put is already in my positions and it's trading below my strike, so let's simulate this. So let's say we want to choose a strike that is higher than the current market price to simulate an option strike that's in the money. So the stock right now is at 52. So let's say the option I sold was at 55. So I'm just trying to simulate an in the money option. So let's say I had sold the June 12 55 put, and now my option is in the money because the stock is trading at 52. So my current strike is in the money. So what I could do is I can buy back my current option that's in the money, and I could sell the next week's, so June 19, same strike, put option. And what that does, I get a credit of, right now I can probably get around 50 cents for that. So that's what I would do with this 45 strike. If it gets in trouble tomorrow, I'm just going to roll it to next week. I'll keep rolling it for a credit. A naked put, you can always roll for a credit. And I'll just wait for the stock to recover again above 45. So I've got a lot of room to win because the stock would have to drop from 52 to 45. And even if it does drop, I can mitigate it by continuing to sell naked puts or by rolling my put forward every week for a credit until the stock trades again above 45. But who knows, maybe it's going to jump after earnings and I can close the trade early without having to go to expiration, without having to worry about rolling the put option forward. All right, so I didn't place the trade yet, so let's go back to calls and puts, June 12. I'm just going to click anywhere here, click on buy sell, make sure I'm under put, choose the strike that I want. I wanted the 45 strike, and then I'll click on, let's say, 75 cents. I want to do 2 contracts, and then click sell. And then you can see it's telling me that my maintenance excess or my capital requirement for this trade is about $2,000. So I'm going to make a small adjustment. I'm going to go for a 44 strike, and I'm going to ask for 70 cents. Maybe put it 65 cents, and then I'll just adjust it as the day goes. I like to make my trade towards the end, the last hour. So in case Chewy drops a little bit, because it really ran up today. So I'm going to choose a strike of 44, and I'm going to ask for 65 cents. So as you can see, it's much higher than the bid and ask. So it's a little bit of an exaggerated order, and I'll just adjust it as I get closer to the end of the day. So I'm going to click sell, click yes, confirm short order. So I'm selling 2 times 65 cents times 100. So that's $130 minus commission of $645. My change in maintenance excess is $19.72. And I'll click send order. So now you see it's in my open orders. And if I wanted to change it or modify it, I simply click on it, click modify, and I could bring the price down, for example, if I want, and then click sell again. And if I click sell, it gives me another confirmation order modified. So now it's 2 times 60, 120, commission 645, send order. So here you go. Now I'm at 44 strike, sell to open, 2 contracts, 60 cents. That's what I'm asking for. It's only going to get filled if Chewy drops a little bit. So this is how you would sell the naked put with Questrade. But first you need to have level 4 options with Questrade first, which you can get through accounts, account management, and under option level you could change to the option level that you want. Now you can only do naked puts in a margin account. You cannot do it in registered accounts. So if you have any questions, leave in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit. The other one gives you $50 in free trades regardless of your deposit. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.